Today, in Pillar 2 of our core growth phase, I'm going to show you why the Indian banking system is currently the cleanest it has been in your lifetime. We are moving the fat we trimmed from IT and oil and putting it into the very institution that are about to fund India's 11.2 lakh crore infrastructure boom. So let's talk about the raw nerve. You have been told that banks are risky because of bad loans. That was true in 2018 when gross NPAs were at 11.4%. As of this week, gross NPAs have crashed to 2.1%. Net NPAs, a microscopic 0.5%. This episode is the bridge between consumer and the capital. We are moving from rural pocket to the engine that fuels it, the banks. As of Jan 6, 2026, the Nifty Bank is at an all-time high, 60,100. But the raw nerve is that retail investors are terrified of the all-time high trap. We will flip that fear by showing that while the price is at a high, the risk is at a 20-year low. Most investors see Nifty Bank hitting 60,000 mark and think, I have missed the bus. They see an all-time high and see a cliff. I think an all-time high should be seen as a foundation. In our active versus passive framework, we don't just look at the price chart, we look at the health of the balance sheet as well. If you're waiting for a 20% crash to enter Indian banks, you might be waiting for a ghost that doesn't exist anymore. For the first time in 2 decades, Indian banks have more safety cushion than they know what to do with. They aren't just surviving, they are sitting on a mountain of dry powder. While the passive crowd is worried about a 1% dip, the active investor is watching the credit deposit ratio. Yes, deposits are tight, but that's exactly why the big banks are winning. They have a brand to pull your money when the small players can't. But let's be real. Why isn't the index at 70,000 yet? Because of 2 thinning risks, the margin squeeze. With the RBI's recent rate cuts, people feared banks' profits, NIM, which is net interest margin, would vanish. The reality? The December 2025 CRR cuts have offset that drag and the squeeze is over. The Jan 27th strike. You might hear about a 3-day bank strike later this month. The strategy? This is the sentiment event and it is not a fundamental event. We use the volatility of that week to build our positions. So how do we deploy this capital? We will concentrate our capital in 3 specific fortresses. The value fortress, which is HDFC Bank. It has underperformed for 2 years while other stocks doubled. HDFC sat still and time corrected. It's now trading at its most attractive valuation since 2019. So that HDFC will be our anchor stock. The power fortress, State Bank of India, SBI. If you want to play the 11.21 lakh crore government CapEx, you buy the lender who writes these checks. Their balance sheet is now as clean as any private bank. And the last one is the growth speedboat, Bajaj Finance. They are pivoting. They're moving away from risky small ticket loans into gold loans and SME lending. With gold at record high, their collateral has never been safer. We aren't buying the breakout, we are buying the fatigue. Nifty Bank is showing momentum fatigue at 60,300 levels. So we are looking for entries in the 59,500 to 59,700 zone. Use the profit booking we are seeing right now to scale it. We want to be fully positioned before the February 1st budget, which is expected to greenlight the next phase of infrastructure spending. We have secured our consumer base, FMCG. We have secured our capital engine, banks. But there is one more pillar. A pillar that protects you if the black swans actually fly. If the Venezuelan conflict escalates or if the US tariffs hit harder than expected, tomorrow we will talk about the chaos hedge. I'm going to show you why gold and silver are no longer just ornaments. They are the insurance policy for your 2026 portfolio. Don't be passive. Be prepared, and I will see you tomorrow. Thank you for your time today, and thanks for tuning in.